All right. Good morning, everybody. So it continues. Quant CTA positioning still underperforming. You can see they kind of topped out back here. If you look at the green line, started setting lower highs and lower lows. That was back in 2024. And since then, it's just been in a complete downward spiral. And they were in the negative, just coming back across the zero line into the positive. This run up that we've had in the S&P since the reversal of the administration's position on the globe with tariffs and everything else, the S&P rallied back up, broke previous highs, made new highs, but CTA positioning still remains subpar, to say the least. So when we look at it from that point of view, there's still a lot of room to the upside, right? It's just getting them back, where they were suggests that there's deep pockets that could, easily fuel this run higher. I'm not saying we're going higher, right? This doesn't tell us where we're going. It does provide insight on, CTA positioning, where money is and how much money there could be brought into the markets. We would want to look at other charts to see, what are they getting out of to get into this? When they were getting out of this, what were they getting into? That way, we have somewhere to look. It's all about money flow and positioning, right? They're not going to just go to cash. The fees and fines for going to cash is exorbitant. It's higher than the losses they would often take if they actually just went into something else. So they're going to get into something else. The question would have been, what did they get into? And if we're going to rotate out now and back into this, what are they getting out of? US markets are basically flat with the small caps up the most, still not even at a 0.5%. Japan closer to that 0.5%. And a lot of eyes are on Japan right now. Remember, they are very often the canary in the coal mine. They are your early warning alert system. So seeing what's going on in Japan and the JGB 10-year, US dollar Japan often provides clues on where we're headed next. We are in the Prime Day, which is today, but Amazon has extended the Prime event for 4 days. Over the last few years, the numbers on this event has really slipped. And so they're trying to really do, different things to pick it up. The projections are 20 billion, which is well above the average. And if you look at what Prime Day has done when it went from 1 day to two, that second day really just doesn't get a lot of juice, right? It's really all the first day. Now it's going to be 4 days. The analysts are arguing over, will the spread out days take money away from the big first blowout day? Or will it just give Amazon an opportunity to net more advertising dollars? Because no matter how much sales they get today, one of the big numbers that people are going to continue to look at is how much money did they make in advertising during this event. And some of the big names that were a part of the article that I read said that they spent heavily for the Prime Day advertising as a precursor to this year's Black Friday event. They wanted to see, how did their money do in advertising during this little campaign as a projection on how well their money might do during the Black Friday campaign. So keep your eye on Amazon. Could get a little play there. If the numbers come in disappointing, might be a fantastic short. And if they don't come in disappointing, then it's very likely going to be just the trudge higher that we've been seeing. Got auctions on both sides in the front end. And then a little farther out, the 3-year, 1 year. We could see something in the overnight coming out of Europe, but I don't expect it to. It's tomorrow night going into Thursday with Japan that we really want to keep our eye on back here. But the numbers aren't far off the mark, so I don't think we're going to get much out of that unless they miss. And tomorrow we got the 10-year. My baby. Nerd. There's been a little bit of whispers about the bonds from multiple angles. One is that the market is still pricing in a rate cut, which is kind of funny, and a bit of a joke, really. Then there's the threat that with what's going on with crude, we could still see, inflation expectations staying firm and or rising, which might put pressure on the Fed and not give them the slack they need to cut. The market's just really ignoring a lot of this at the moment. And that's starting to freak analysts out. They're getting kind of sassy in their interviews talking about unicorns in the sky, and the market's just flat out ignoring risk. But really, I think they're just talking their book. Sounds like a lot of them are short and they're getting run over, and they're getting a little salty about it. Sounds like a you problem, huh? We did not see the put wall get rolled again. It actually held still, didn't go up or down, and neither did the call wall. So this is the first day in I don't know how many days that we didn't get a change to the call and put wall positioning. I had to do a bit of scrolling there to even find the darn thing. It's way out yonder, 55.50, basically, well under the 10-week, as it should be at this point. We would have to really do a lot of damage to get down into that put wall. There was a lot of talk yesterday, especially in the afternoon, about getting back above this white line. That's the 4-period daily moving average. Nobody can see the future or try to anticipate where we're going next. But in this pullback that we had yesterday, one of the focus that I had was we really just need a pullback, right? It doesn't need to be something drastic like we had back here, just a 1-day pullback, get a little bit of a reset. And it's the old adage that everybody learned when they started to trade, right? Buy low, sell high. Well, to get that, you kind of need a pullback. Otherwise, if we just keep making highs, where's your entry? Buy at the highs like Investors Business Daily tells you to do. It's not bad for the indexes, but it doesn't really work that well for penny stock junk, low float trash. So we cut the 3 or the 4, whichever one you like to use. We cut it yesterday. So far, we're back above it. That needs to stick. Otherwise, we can test the 10 That's 62.30 cog line. And it's just the 10-day, not the 10-week. But really, it cuts 62.50. And that's the level that we tagged yesterday as the line in the sand that we talked about yesterday. If 62.50 fails us, then 61.50 is on the table, which is the 20. It won't matter where that 10 is. Right? We've been running hundreds from the 50 point, and that's very likely what we would run again. Judging the pullback, we haven't even gotten to a 786 necessarily yet, right? Depending on where you want to set the hook. I guess we did get there. So we got our 786. That has to keep. It's basically 62.50. Otherwise, we run the halfback. And if we do keep, then 63 and 63.63, and then 64.11 cog line as the next leg up. So basic price action 101, we've set our high. We don't yet know if this is our low because we've started to pull back. This bar is still open, so it doesn't count. For all we know, this is just a wick, and we're going to end up, falling down here and closing somewhere here. So we don't know if this is our higher low yet. And we would have to come up and break this previous high to have this be nothing more than a pullback and a continuation of trend. Cutting through our own open from last night would be a good tell, and then breaking yesterday's low and continuing to the downside would obviously be a good tell. It would kind of confirm that what we have right now is just the wick, and that we could end up with a day that looks a lot like this, where we opened and had a run up, and then we looped down, right? Something like that. We are closer to the upper ADR than the lower ADR, which implies that we'll just go ahead and get it. It doesn't owe us though, so we got to keep that in mind. And to hit the lower one, we would need an inside day breakout to even get there. We are through the half of yesterday, which is a good start. If you think about a bearish bias, right, you got price isn't going to just drop in a straight line. It walks, right? It's just what it does. So you get a drop, retrace, say about 50% of the previous day, get another drop, retrace about 50% of the previous day. You kind of get the idea, right? So far, we don't know if this is just the pullback before the next leg lower, or if this is going to be the recovery bar that runs us back up. Let's get to the ADR half first. Basically 6,300. And then we'll go from there. Above that, we have yesterday's RTH open. It'd be a pretty significant pivot point to deal with. Then the Globex open, then yesterday's high, then the full ADR, which is close to last week's high. Good times. Otherwise, a continued break. If we get back below the half, then we got 38 and 30, then the lower ADRs. That would be a inside week breakout, right? Breaking out of last week's range. It is worth noting that we're below the weekly pivot point. Just on a, like a off the cuff sort of bias where we at, below the weekly pivot point puts us in a bearish bias. Now, it's not like we want to go out and buy a bunch of shorts. We're not that sort of bearish. We just lose a lot of that bullish enthusiasm when we're underneath this significant level. So 62.92 cog line, weekly pivot point in a really wide weekly channel. Sure, we're back inside the weekly channel. We still got to get through that weekly pivot point. Last week, we opened really far above that line, which was all the way down here, right? And we opened far enough away from it that when we tried to run even farther away, we just really couldn't get anywhere. And when we opened it this week, we were basically sitting on it. So it didn't take much to get underneath it. Right now, the key is to get back above it, get outside of that weekly channel, and we could easily get 3.5 to 4% away from that pivot point without having any consideration of being overbought or overextended or anything like that. So we got plenty of room to run. One analogy with that logic would be to consider something like sports, say take soccer or football, basketball, something that starts in the middle. You got plenty of room to run in either direction, but you're still split by half a court, right? You're back to the starting line here. Got distance to run in either direction. Same analogy. Doesn't get any better than that. If you're looking for a short-term run over the next 3 to 5 days. Especially if you can do it while everybody else is negative. The call positioning really didn't get very good yesterday. You know, during this fall, I thought it would have cleaned up a little bit and offered some better longs, not on the ES necessarily, but SPY, SPX. And sure, there was a little change, but not a lot. The markets were really signaling yesterday that there wasn't much to this, or at least the options market wasn't positioning for more negative moves from here. The calls really didn't adjust that way. We see the numbers really change up on the calls. We'll start to see the market's heavy hand looking for a short. They weren't looking for a short yesterday. The ES made it to S2. I think the SPX made it to S3. It's worth knowing where those levels are at if we begin to expand. I don't like leaving them on all day, but you might want to know where they're at. So we made it through this shallow distribution relatively easy as we would expect. And they took a little front run on last week's point of control. It's very likely there's still a lot more down here. How much liquidity would be a completely different discussion. But that one small test does show that last week's levels are going to be defended heavily as they did yesterday if we get a chance to even get back down there and try it again. Otherwise, we've got a pretty ugly distribution at this point. And the value area takes up most of the week's range. So we want to see this tighten up through the day today. A lot of work in at 6,300. I would watch for a little more defense there. And if we do get a chance to break out on yesterday's high, and go higher. Watch that 63.32 cog line. We can see the work that they put in last week up at that area, 62.25 to 35, that whole zone. The July anchor is 62.70-ish, basically. We've cut below it as we were developing it last week. We're really looking to establish ourselves above this zone. Right now, we're just cutting back and forth, right? There's not a lot to it. The reason I bring it up is we could see reciprocation, right? This little bit that we had to the upside, we could see to the downside. It still wouldn't put us in a bearish bias per se. It's just trying to shake things out a little bit before we start to outrun this anchor like we outrun the anchors in general. If we do happen to see that sort of shenanigans, yeah, about 6,200. Right? You can get kind of stuck around these levels, right? Before you finally start to get away. Ten-day, 30-minute volume profile and TPO, they're lined up. The point of control on the TPO and the volume profile. The value area on the TPO is a lot cleaner. I'd be watching for that through the day today. It's not hard to see where it's going to go, right? One, we can just look at what it did over here, but two, we still got this high level right there. So I'd look for that level to come up. These candles are what made this current distribution, and we're not going to get there for at least a week. So the only thing that's going to move this point of control right now is for us to go somewhere else. The most obvious answer would be that we continue this move to the downside, see these lower highs and lower lows, continuing that move to the downside until we get back into this 6150 area, which I mentioned we're running hundreds off the 50. So, breaking 6250 offers 6150. If we continue this move to the downside and reinvigorate that zone, then 6150 starts to get some footsteps again. We won't even start taking these out for another day and a half. And when we do, by default, we're not going to get anything out of it because we've already got the point of control up here. Trying to look at where we're going to go next. One thing that we're going to get is a narrower distribution. So we got to see the value area low come up. And we got to figure out where this point of control is going to go next. Once the weight of this previous work is off the table, we could see something up here at this 63.25. It doesn't look like much now, but we're comparing it to everything else that we have on the table. And for, any sort of classic distribution, we really don't have much. This value area low screws up any idea that we could be seeing some sort of, P-shape profile, because we don't have that when this distribution is here. And that would only be on the TPO anyways. It wouldn't cover the point of control. So we don't even have a classic distribution at this point. No new VPOC from yesterday. Just borrow that line. And this morning, we don't have much of a discrepancy between the TPO and the volume profile, and the point of control lines up on both. No real insight either along the lows of where we opened and on that run up, but we can really see the effort they've been putting in across these highs, which makes sense. It's where we've been for half the night, and we put in a lot of work here. I think at this point, we really don't want to go and revisit the initial balance today. We are still within the range on the week. We didn't even get to the week's edge yet, but we certainly got close. Previous times when we've gotten this close on the first day and then we've pulled up a little bit, it's not uncommon to go ahead and come down and get below the line. And then whether or not we keep it would be another discussion. But getting outside the box and then coming back in again, there's nothing wrong with that. It's closing outside the box that we don't want to see. Although, we tend to get that too. Price has been breaking the weekly expected move consistently for a while, and it's going to take a lot of work to get the numbers back up again. So we're still not even running with a classic standard deviation. We're still above the 10-day, back below 1%. So, if you've been around for a while, we generally look for price to be within 1% of the 10. It's the 10-day. And when we exceeded that over the last week or so, it was consistent. We were staying underneath 2%, which is good. We weren't getting overextended, but it was a bit more than we're used to. You'd normally want to see it between 1% and say 0.5%. So we're back inside that zone now. This has to end at some point, and what I would be looking for is whether or not we're going to get an extended drop to the downside after staying range bound like we did back here, like we did here after being range bound, or if it's just going to be a quick dip and then a run back out again. And it doesn't have to even cross the 10 and give us anything like this yet. We could continue for, say, another week or two with this sideways. You can see it can last for extended periods of time. Right? That was like 3 months of sideways right there, all within that 1.5% to 2% zone that we're talking about. 3 months. We're still more than 3.5% above the 10-week. We are on the pullback at this point, but we were getting a little extended anyways. And there's just nothing here yet. It's still really positive. It's not extreme, which is good. And we're backing away from the edge, or backing away from extreme, which is exactly what we would want to see. There's still nothing here yet that says we're in a bearish trigger or bearish bias. And I wouldn't load up on the bear side other than some lottery plays, right? Something cheap and not an entire change of your portfolio to the downside. That little dip we had yesterday is nothing, right? And even if it is, even if this is the start of a bearish play, we're still looking for a move up to set that lower high. So, you're not going to miss anything anyway. I don't know about you, but I'd rather short from the highs and not short from the holes. So the VIX is giving it back a little bit over a 5-day change. The VIX is still up 2.5% after giving back 4. So it was up 6.5% in a 5-day period. This morning we have China, 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 Bitcoin, Quantum, the Mag 7. If we're looking for a rally day, those are the sectors that I would want to see to get that rally. We're being led with pot stocks. That's not what anybody wants. But behind that, we do have China. Nat gas is kind of a joke. China again, Bitcoin, uranium, chips, Mag 7, and that's what we would want, right? That top 10 with those sectors are the kind of sectors that I would be looking for a rally day. To go with this, what I'd like to see is finance, but I think it was Goldman that was getting whacked this morning. Yeah, little algo print, really nothing there yet. See if that fleshes out a little bit. Keep your eye on banks, financials. You could use XLF, but it's a little generic. Maybe want to use something more closely tied to banks like KRE or something like that, regionals. Credit cards, lending institutions, insurance companies, trading desks, they all get lumped into that XLF and it just muddies the water a bit. Right. But on a rally day, there's 3 sectors that really work together to give us that rally. It's XLF, XLK, and XLY. Tech, financials, and consumer discretionary. So top 3 risk on, bottom 3 risk off, 3 in the middle or midline. And of course, these are generic. We can obviously replace XLK with something like chips, software, cloud computing. There's a lot of things that can, be labeled as tech. Or you can just use something like the Mag 7 ETF. These are the sectors we'd want to see in play. So we want financials a part of that conversation. And so far this morning, we really don't have finance in the game other than, like Bitcoin. So that would be one thing worth keeping an eye on as a tell. See if we can get some participation in that lane. On that sell-off yesterday, banks were kind of holding the line and built this channel here, while NY Fang gave it up, broke down a bit more. They both managed to, try to come up a little bit by the end of the day, but we're getting these guys this morning. The NY Fang doesn't work in pre-market. We'd want to swap that out with something like MAGS. You can see they're coming up a bit, but not much more than finance this morning. We want more of these guys. Looking for stocks in the NASDAQ 100 that are up at least 0.5%. We've got 18. That's not really inspiring, but out of those 18, nearly half or maybe a little more than half are all chips. That's a good start. Just we need more for this rally than chip stocks. And the other half of that for the S&P 100 names that are up at least 0.5%, we've got 10. That's not overly inspiring for a bullish backdrop. Sure, we got some chips. We got other Mag 7 names in there. I mean, Meta's up this morning because they're spending millions and millions of dollars for sign-on bonuses for AI people. Sooner or later, they're going to have earnings and have to report that. Who knows, right? The market has always punished Meta when it comes to spending. That's not really the focus for today, but you know, they're up, but they're only up because they're spending a fortune and stealing AI employees from other companies. Right now, they're taking Apple's top guy. So if we're looking for a rally day, the point is we don't have the broader market backdrop, and that's one thing to keep an eye on today. We'll see options flow once we get into the open. Nothing to look at this point. So watch for the 0-day options flow to pick up, give us a boost to the upside, the broader market backdrop to pick up, kind of fuel that rally. A rising tide lifts all boats sort of scenario. Some sort of hedge fund factor rotation or short covering rally, something. Because right now, we don't have anything. We're just sideways sitting in the middle of yesterday's range. And it's a fairly wide range. We could spend all day doing nothing but holding inside of this zone, just chopping it up. And that would make for a pretty boring day. So GTFO, we got to get out of the box and do something. This exaggerated move in the 10-year is worth keeping your eye on too. It had to happen, right? If the 10-year is supposed to remain in a collar, that's not the right word to use, but let's just use that. If the 10-year is supposed to remain in a range bound environment, then we broke that range to the downside. It was really expected that we come back inside. So yay, we came back inside. That's not necessarily quote bullish for yields. It's more of just it went too low and now it's coming back inside the range. Where it's at is only one piece of the puzzle. The other factor to really keep your eye on is how fast it's moving, right? The rate of change on the 10-year and the dollar is often more important than what level they're sitting at. So we want to see this thing calm down a little bit, begin to stabilize. We don't want to see big sweeping moves too far, too fast, really freak everybody out. And of course, you can always start to measure how deep is the pullback. Was the next pullback as deep or deeper? And if it is getting shallower, what about the run up? Are the runs up increasing in length? Or are they decreasing? Kind of get a tell for, is this move slowing down or speeding up? Is it happening with more participation or less participation behind the push? So nothing really big on the economic schedule. It's the same stuff coming out of the White House when it comes to the tariffs. Keep your eye on broad market participation and options flows at this point, and hopefully get something out of the financials to get us out of this range that we're in. That's what I got for you guys. Be careful, be safe. I'll see y'all tomorrow.